Hey everyone, it's Tuesday, October 25th. Today we're talking with educator and Wycoffian Bruce Fraser. We'll talk point and figure today, which will be a lot of fun, talking about key levels and key objectives for the S&P 500. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the technical toolkit to better understand investor psychology, better quantify investor behavior, and make sense of these markets. Happy raging bull market phase, which is what it feels like after taking yesterday off, spending a long weekend recovering a bit and looking at the charts here. A lot of movement to the upside, right? And we've sort of tentatively labeled this a bear market rally. And we'll have to look at the evidence and see what levels you might want to relabel it. But labels aside, follow the trends, right? The most bullish thing the market can do is go up. That's what I'm seeing when I'm looking at individual names like Ross Stores and others that have been beaten down for a while, rotating nicely to the upside. We'll look at as many charts as we can here in 30 minutes, try to make sense of things in the midst of a busy earnings week. We have a great guest today, Bruce Fraser, fantastic educator at Golden Gate University for a number of years. We're going to talk point and figure charts, which I'm excited about. We are underweight point and figure, I would argue, on StockCharts TV. So we'll have a little brief masterclass here in a minute. Tomorrow, we have Mish Schneider of Market Gauge, and then on Thursday, Jesse Felder, editor of the Felder Report. Let's continue on our show today with the market recap. I did want to start with a poll. We always have a poll going on our live stream page at StockCharts.com, on our social media accounts. So make sure you follow us on Twitter at FinalBarSCTV and at StockCharts. And here was what we asked you recently. In an uptrend, you have a candle with the open and close around the same level, a long lower shadow and no upper shadow. Which pattern is this? I got a group of you to get one of the what we call the distractors, one of the incorrect answers, hanging man. The correct answer is actually that's not true. I got most of you to answer wrong. I'm looking at I'm trying to answer the question in my head as I'm looking at it. 44% of you said hammer, which is actually incorrect. 40% of you said hanging man. And that's the difference is the beginning of this question where I said in an uptrend. What happens with candle patterns, a hammer, a hanging man, an inverted hammer, and a shooting star are basically four different candles that look very similar, right? The open and close either at the upper end of the range or the lower end of the range with a limited shadow on the one side of it. If it happens in an uptrend, if that pattern happens in an uptrend, it's called a hanging man, where you have the open and close at the highs and then a long lower shadow. If that would happen in a downtrend, it's called a hammer candle. And it's funny, it's a nuanced thing, right? It's a labeling thing between those different candle patterns. What is consistent across all of these, anytime you'd see that pattern where the open and close are right around the same level, it represents indecision and is a short-term reversal candle. So if you would see a hammer candle in a downtrend or a hanging man in an uptrend, those are indeed a reversal pattern. So I got some of you on the labeling, but hopefully you understand the values in thinking of candles and their short-term implications for market sentiment. Let's continue on our market recap, looking at the major averages and how they've evolved. The S&P 500, decent update. And it wasn't just, at the close, it wasn't just out of the open. It was sort of all across the board. So the first 30 minutes of trading, pretty strong. The last hour of trading overall, pretty decent as well. The S&P finishing up 1.6%. That's just below 3860. A long way off from 3,500, which we touched, I feel like, not too long ago. But it's been receding in the rearview mirror as we push to the upside. The NASDAQ composite up even more, up 2.25%. Mid caps and small caps up as much as 2.5% today. The VIX now way below 30. We got down to 30 yesterday, and at the end of Monday's session had closed, or the VIX at end of the day just below 30. We continue to push lower through the course of the day today, with the VIX touching around 28.45 at the close. So the VIX back below 30. And as we've talked about a number of times, the VIX above 30, sort of a characteristic of an elevated volatility environment in 2022 for sure. That's been the signal. And coming back below 30 could be the sign, certainly, of a meaningful recovery, as it certainly appears to be framing out on the price action itself. Interest rates coming off a bit as well. And if you're wondering how the markets can be rallying at this moment, besides ragingly positive earnings, which I don't know if that's how I would necessarily describe it, but I would tell you that interest rates coming down and the dollar weakening a bit is certainly giving room for growth stocks to do just fine. And you're seeing a lot of names, individual names, sectors, sort of pushing off of the lows and bouncing to the upside. The only way that's possible, I would argue, is because the dollar has essentially not made a new high in the last couple of weeks, and interest rates are coming off from an extremely high level for the 10-year. Now, could interest rates go even further? Could the dollar go even further? I think they absolutely could. But again, don't think about what could happen or what should happen. Let's focus on the charts. And for today, you're certainly seeing an alleviation of that recent strength in rates and in the dollar. Commodities, for the most part, in the green. The gold ETF up 0.25%, silver up 1%. Oil prices up a little bit as well, although energy was the worst performer of the 11 S&P sectors, just barely above zero. A big movement higher in cryptocurrencies over the last 12 hours or so. You see Bitcoin up about 4%, above 20,000. That's key, actually, because we talked about for quite some time. I've mentioned, and whenever I'm asked about the chart of Bitcoin, I say, all right, Bitcoin's way below 20,000. When it could get above there, that's my line in the sand, at which point I will agree to revisit that chart. So as promised, today's the day. We got above 20,000 for the first time in quite some time. We'll look at the chart together here in a few moments. Ether prices, by the way, up over 10% today. So all the 10 coins that we track on our market dashboard moving nicely to the upside here. So when you look at a chart of the S&P 500, again, we were off yesterday, but when we talked last Friday, we had just reached to 3750. And the comment that we made, and I know what I shared with my premium subscribers at Market Misbehavior over the weekend, was 3,800 is an important level for a number of reasons. Right? And you can come at it from a number of different places. Most simply, it was the high from earlier in October, right? So a downtrend is a pattern of lower lows and lower highs. An uptrend is a pattern of higher highs and higher lows. So if you want to know when the trend reverses, I would say Charles Dow's simple definition is the highs stop getting lower, they start going higher, which we saw today. The lows stop getting lower, right? So we had a lower low going into mid-October. Now we've arguably made a short-term higher low there in the last couple of days, and now rotating to the upside. So we've gone in the short term from a pattern of lower lows to higher lows, from lower high prices to higher high prices. That tells you, again, at the very least in the short term, the trend has really pushed higher. 3,800 was the level, though. That got us above the high from early October. That is also a key Fibonacci level, right? From a number of different reasons. Most recently, if you take the high from mid-August, you take the low from mid-October, 38.2% of the way up is around 38.10. We just closed above there today with the nice rally through the course of today's trading session. 38, 10, 15, 20, thereabouts is also a Fibonacci level from a number of other sources. Most importantly, I think from March 2020 to January 2022, that's the 2020 low all the way up to this peak at the beginning of 2022. 38.2% of the way down is right around 3,800, just above there. So we have a number of different approaches all telling us 3,800, 3,810, pretty key. So the question now is there enough gas left in the tank to push above the 50-day? And if so, what? I would say if you get above the 50-day moving average, 4,000, a very important level. That's the 61.8% retracement. That would take us about 2/3 of the way back up from the August peak to the October low. We could get to that point, still very much be within the framework, I would argue, of a cyclical bear market, but have a nice recovery rally, a nice relief rally going to those peaks around 4,000. If and when we continue further, which I think we may, I would be looking for potential resistance at that level. And what's so interesting looking at the chart of the S&P 500 is the bullish momentum divergence. Look at the lows in price in September to mid-October. Look at the higher momentum reading from late September to early October. That's not just the S&P. The charts of Microsoft and Alphabet and others have a similar pattern. Charts of a lot of individual names show that particular pattern. So keep an eye peeled. That is one of the great leading indicators, I would argue, in technical analysis. When a market goes lower and the momentum starts to alleviate, we certainly got that signal in the last couple of weeks. Let's take a quick commercial break. We'll be back with today's guest, Bruce Fraser. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. I mentioned how it's rainy, and I can't believe how the people of Seattle have been praying and hoping for rain because excessive rain has driven away all the wildfire smoke, hopefully brought the wildfires into a manageable condition, and definitely has improved our air quality around here. So we're pretty thankful for that. I want to bring on today's guest, Bruce Fraser, here in a few moments. But before I do so, a couple quick announcements. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show. And we'd love to feature one of your questions live on the air on Friday's show. You can get your questions to us via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, or on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday. Also, go to StockChartsTV.com. We are so fortunate to have an incredible group of contributors like Bruce Fraser, like Miss Schneider, like Joe Rabel, like Larry Williams, and so many more, offering their time, their expertise, and their investment wisdom for all of you. It's all for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on my friend and Wyckoff expert, point and figure expert, and certainly an expert educator, Bruce Fraser. Bruce, it is a pleasure to see you after ChartCon, where we saw you in person not too long ago. Welcome back to the show.
Dave, thank you so much for having me. I'm still in the glow of ChartCon. So much fun to hang with all of you. And I was just saying that it felt like it was a high school reunion or something. And I hope that really showed up in the broadcast, because we sure had fun presenting all that great material.
We were enjoying ourselves, I think, on camera and off, for the most part, was my experience. Let's get to your chart here, Bruce. You have a chart of
Sure.
a point and figure chart of the S&P 500. Can you talk us through it, what it tells you about the structure and where we may be headed?
I made this chart just for Final Bar, and I want to just really kind of focus on the swing trading features in the point and figure. This is a 3-box reversal point and figure of the S&P 500 index, 25-point scaling. And you can see back here where the number 9 is, that was the cause built after an important decline into the June low. And that green shaded area represented a swing trading count that took us up to 4325, 4400 from 3650, best rally of the year, and worked out so beautifully. Came back down again, and into the September end of the quarter period, we have another cause forming. We've talked about this in power charting. There are green shoots. I like to call them green shoots, which are internals of breadth that are improving. And those green shoots, you can actually see the last 2 episodes, I focus on those. But anyway, in power charting. But here, just keep in mind that we have this beautiful reversal, 2 extra columns, or 2 extra columns of count, not columns, but 2 extra entries in this column of X's right now, up to 3850. So we've broken out the prior peak. Important. This count goes up to 4025 to 4175. And that 4175 area, Dave, looks really important to me, because it's the area of the resistance that was set up at the June high. And so you can see there that if it can get to that place, and then I put in a speculative down arrow, making the case, could we build a larger count for a bigger move? And if we see the right conditions, this is all tape reading, but if we can see the right conditions in a pullback, diminishing volume, diminishing spread, maybe just a flat kind of stalling action instead of a big pullback, it's possible that that whole pink area there could be a count. Now, this is a very speculative idea at this point, but we'll be watching for this, where we could have a bigger count that could lead to a bigger move. And so the only other thing I would point out on this chart is that you can see the volume, wonderful feature of StockCharts point figures. You can put volume in. Note how the big climactic declines all come on very high volume, and the subsequent tests all come on diminishing volume, which shows the characteristics of potential absorption and exhaustion of supply as a cause is being built for a more important advance. So that's what I have here, and I think it's compelling. And I think 40.25 to 41.75 is a very real possibility in this rally phase, and potentially bigger.
Yeah, it's such a great illustration of just the structure of this market, Bruce. And I'd love to ask you, as you think about the potential, right? We've obviously had a sort of a double top breakout, sort of validating this potential upside. You've given some upside targets and then suggested maybe we then retest and come up with a larger count. What does I guess, what's the time frame that might be implied from point and figure? Is there a time frame that comes out of the point and figure chart as you analyze it, or
yes,
from another Wyckofian approach that would suggest some sort of time frame for that?
Yeah, very important question. That's sort of in the realm of cycles. And I would say that point figure horizontal counting can't give you the duration of a potential count, but it does tend to give you the objectives. And so the only thing I can suggest here, note that I labeled this a spring at the low there, and it turned around and very sharply came back up through the old support, which became resistance at 36.50, came in and quickly and sharply. And often when you have a spring, that is a measure of the near completion of accumulation. And that shows that there's an imbalance of demand over supply, and you can have a very quick advance up to an important resistance area. So that would be the best way I'd know how to really answer that, is to say that if this is true accumulation on a scale, it should be able to move easily and with not a huge amount of volume up to higher levels.
We only have about 30 seconds left, Bruce, but I'd love to ask, because we're showing point and figure. I'm always kicking myself that we don't use the tool more often on StockCharts TV, because it really is a beautiful way of demonstrating. If someone's not familiar with this, what would you suggest they do? Resources or somewhere they would look to learn more about how to use point and figure charting in their own process? In my Wyckoff power charting blog, I've written a number of blogs in my through the whole time period back to 2015, 16 on how to construct point and figure and how to count horizontally. The other thing is I did a couple of evergreen workshops that are on StockCharts TV that are shown over and over again, but are also available on the channel for on-demand viewing. And so those are also great for just how to construct them, and then simple counting technique. Bruce, it is such a pleasure to see you again. It was great to see you and your wife in person here in Redmond. Stay safe there in Nevada, and we'll talk to you again soon, all right? Thank you, Dave. Thanks for having me. That's Bruce Fraser. Bruce is from WyckoffAnalytics.com. He's the host of Power Charting, which runs every Friday, 1:30 Eastern on StockCharts TV. I would echo his comments about point and figure charting. I, at times in my career, have used point and figure charting heavily. So I kick myself when I talk to someone like Bruce and others who have used point and figure charts, that we don't leverage that charting style more often on StockCharts TV. Hopefully, I will be able to help change that over time. But for now, check out some of Bruce's writings and also his previous videos. He does a great job of incorporating it as part of a holistic investment approach. Great take there from Bruce Fraser, as always. Let's continue on our show today with the final bar mailbag. As a reminder, our mailbag is always open to help point you in the right direction on the markets, hopefully on the markets, but certainly on the technical analysis toolkit. So keep your questions coming. And here's question number one. Dave, I loved your work on the Hindenburg Omen, as it turned out to be a very prescient call. Is there an indicator that counters the Hindenburg Omen? And I appreciate you so much saying that. I will tell you, the Hindenburg Omen is a fascinating one. I actually had a question. Well, this is last week. I think one of our questions was on not the Hindenburg Omen, but the Titanic syndrome, which is a sort of related kind of similar indicator. This was the chart that we talked about, previously, and this is the signal I think you're referring to. In November and December of 2021, you had this signal, and if you go, what you need to do if you don't understand the Hindenburg Omen, hit the little magnifying glass, type Hindenburg Omen, and look at the chart school articles that describe it, also the blog posts, because there's a lot of great resources to help you understand it. But it's very simply looking for a market in an uptrend, and it has a way of measuring that. And then it looks for an expansion in new highs and new lows. So over X% of the NYSE listings are making a new high and a new low. And Jim Mieka, who created this approach, thought that it's sort of bifurcation of the market, new highs and new lows at the same time represented indecision, and that was often a sign of an overextended market. Then the McClellan oscillator goes below zero, and that triggers the Hindenburg Omen. And if you get a cluster of signals within 30 days, that tells you that conditions are pretty bad. The last two times we've had these valid signals are in December of 2021 and February of 2020. Not too bad in terms of identifying some key peaks. Now, the Hindenburg Omen, as you can get from the question, is not meant to pick out bottoms. It's meant to pick out tops, and it is uniquely designed for that. So is there an inverse version of the Hindenburg Omen? So the inverse of those rules actually don't work particularly well. And I think it speaks to the fact that markets top and bottom in very different ways. And if you look back in late 2019, you can see what I mean. I was told that the market take the stairs up and the elevator down, and you can see that uptrends tend to be, more gradual, more consistent, sort of a gradual accumulation. But when people panic, they don't, slowly, gingerly panic and lighten up their positions. They dump everything, and that's what causes the market to go down so significantly. That's why the rules tend to work. So it's on my list to think about potential bottoming signals. I actually just did a webcast a couple weeks ago called the Market Bottom Checklist, where I teased out 10 items that I would look for. And I will tell you 2 of them that are the most leading indicators that I would certainly probably include in some sort of inverse Hindenburg Omen. I'll have to come up with some encouraging name and not Titanic or Hindenburg. So I'll work on that. One would be bullish momentum divergences. So I think the fact that the S&P made a new low on weaker downside momentum is pretty meaningful. I think that's a key one. The other one is small caps outperforming. So if you look at like the relative strength of smalls versus larges, hard to see here because they underperformed so much in 2021, but it's actually started to improve a little bit. So there are other things I'm actually working on to try to think about maybe an inverse of that. If I can come up with something really good that tests very well, I will gladly add it to the StockCharts platform, and I will tell you on the show when I do so. So my short answer is no, I don't know of one that's a beautiful inverse of that, but I know a lot of people have tried to look at the characteristics of market bottoms, and it's on my research list for a rainy day as well. Next question. How can I create several tickers that automatically get updated like $NYFANG of yours? Yeah, I showed a chart of this index not too long ago. And someone asked a question about this. Basically, how do I create my own index like that? So the short answer is this is not actually an index that I created. This is an NYSE published index. It actually updates intraday. We have it as a part of our normal feed from the New York Stock Exchange, and it's $NYFANG. It's called the New York Stock Exchange FANG Plus Index. So that's not one that I created on my own. It's actually one that's publicly available. And if there are other indexes like that that you hear of that you can't find on StockCharts, just hit our help group, our support team, and let them know. We'll be glad to add them to the platform as well. So the short answer is, how do you do that? Excuse me. The short answer is you can do it. We actually have the ability to create your own user-defined index. And if you click on charts and tools, it should be right here, user-defined indexes. You can actually import your own database, or data sets. So at one point, I wanted to import the actual values on the Fed balance sheet. I found them from a third-party provider. I put them in an Excel spreadsheet, uploaded it into StockCharts, and then I could chart it along with all my other indicators and things like that. And that's what I've generally used for that kind of approach. Create something in Excel, import it into StockCharts. Now, part of our vision for the StockCharts platform is to give you a lot more capabilities along these lines and allow you to do some really cool indexing. So I want to create my own Dave Keller benchmark with these weightings on these stocks. Let me chart it over time. It's coming. We're working on it. Next question. On October 13th, there was a gigantic swing from a really low open to a really high close. Is there a conclusion that you have about days like that? And your question actually was a pretty detailed one. I kind of summarized a lot of your comments, but you mentioned about the stocks that I observed. And this is this day that you're asking about here, the low when the S&P hit 3,500, then reversed very quickly. Stocks were down 4 to 7% right out of the open. They closed up 3.5%. Now, in your question, you sort of implied a sort of a conspiracy theory type of thing, right? Who's out there manipulating things, pushing things lower just to burn everyone out and then buying low? On days like that, I often get questions about some sort of thing, right? The machine is trying to take advantage of individual investors, drive the price downwards to get everyone shaken out, and then take on these huge positions. I don't think there's a nefarious feel to that necessarily. I would say that algorithms absolutely play a role in this, because what happens is if a lot of algorithms are looking for a certain price point, let's say a bunch of hedge funds have an algorithm that kicks in when the S&P hits 3,500 for whatever reason, there's enough volume there and it triggers enough buying that can actually create a cascade of buying, and everyone that is short or is just sold all of a sudden sees the reversal and they get in on it. And that's what can create those feedbacks so quickly to go to the other side. I would argue that these sorts of movements absolutely are exaggerated by algorithmic trading and automated systems, quantitative systems that are looking for anomalies. And that was certainly an unusual open, a gap down, and then further to the downside. I think that's less market manipulation and less anything, again, nefarious, anything of that sort. I would argue it's more just automation of a basic principle, which is when a market gets really disconnected, bet on a mean reversion. What it does tell me is to really believe in reversal signals like that. This is a classic candle pattern called the bullish engulfing pattern. Regardless of what you think that bar represents, it's certainly, in terms of how it's created, it certainly implies the fact that the short-term sentiment has reversed, and that's arguably been a really good sign for the last couple weeks. Thank you guys all for those questions. Those are 3 fantastic questions. Please keep them coming. We'll get some more of them on Friday's show. We need to wrap today's show and go to the 3 and 3. Here are 3 charts that tell the story of this market in 3 minutes. Here we go. Chart number 1 is the S&P 500. I had a lot of fun there talking with Bruce Fraser, expert in point and figure charting. It's great to just see some of the different measurement techniques. And if you didn't follow some of the things he was talking about in terms of the horizontal count, in terms of the price objectives, please use our chart school capabilities. Search for those keywords in our chart school. Also go to Bruce's previous videos on point and figure. Really well done, and help fill in a lot of the details we weren't able to get to. I did think his observation was really, really interesting. And if you think about it, that would take the S&P sort of in this 4,000 to 4,200 range, which would be sort of between a 61.8% retracement of the last couple months, all the way up to 100% retracement up to the August peak. So interesting upside objective, and I think completely reasonable given the strength that we're seeing in this week in particular. Chart number 2, Alphabet, right? We have a lot of earnings this week. We didn't even get to some of the earnings names this week because there are a ton of them and some key names. Alphabet, Apple, others all kind of coming out. And again, while they tell you things about the individual companies on a broader level, it tells you a little bit more about what is priced into the market and what the expectations are going forward. What I'm seeing so far this week is pretty constructive. I'm seeing constructive price action coming out of the lows. When I'm looking at a chart like Alphabet, I can't help but notice how the RSI has remained below 60 pretty consistently since September of last year, which was near the peak for Alphabet. From there, every rally has seen the RSI stalled out at 60. If you want to assume that this is different, that this is the beginning of something more significant and a more meaningful upside, I would be watching this chart like a hawk to see if we can finally break that pattern. RSI getting above 60 tells you something is different. Finally, the chart of Bitcoin. I promised that Bitcoin gets above 20,000, we will revisit it. It happened today. Of course, as we're recording, it's trailing back down to 20,000. But I would say upside objective to around 25,000 makes sense. Excuse me, that is the 200-day moving average. Maybe something to pay attention to. But as always, watch the risk for potential move to the downside. Folks, that's a wrap for our show. I want to thank Bruce Fraser joining us from Reno, Nevada. Also, always some great perspective. For StockCharts, I'm Dave Keller. Be safe. Have a great night.